What if your financial decisions today could drastically affect your future, even decades down the line? Whether you realize it or not, certain financial habits can make or break your long-term financial health. In today's video, we'll dive into the top 5 financial mistakes that hurt you in the long run. These are mistakes that can quietly destroy your future wealth if not addressed. Stick around to learn how to avoid these pitfalls and build a more secure financial future for yourself. Let's get started. 1. Taking on too much student loan debt. Student loan debt has become a major issue for many individuals, with the total amount in the U.S. approaching $1.8 trillion as of early 2025. While education is essential, borrowing too much can put a serious strain on your future financial goals. Large student loan payments can make it difficult to save for retirement, purchase a home, or invest in other assets. Worse, student loans are one of the few debts you cannot discharge through bankruptcy, leaving you with a long-term burden. Instead of taking on too much debt, look for scholarships, grants, and part-time work to minimize the amount you borrow. Also, choose schools that align with your financial goals and offer reasonable tuition fees. By minimizing your student loan debt, you can set yourself up for better financial flexibility in the future. 2. Borrowing from retirement accounts. Taking a loan from your 401k or IRA might seem like an easy way to handle a financial crunch, but it can significantly harm your long-term retirement savings. Not only will you lose out on potential growth from your investments, but you'll also face penalties and taxes if you withdraw early. Even if you take out a loan instead of an early withdrawal, the money you borrow isn't working for you. It's sitting out of your retirement account, missing out on the power of compounding. It's best to avoid dipping into your retirement funds whenever possible. Consider using other sources of funds or seeking financial advice on how to handle short-term needs without sacrificing your future. 3. Buying a home that's too expensive. While owning a home is a significant milestone for many, buying a house that is too expensive for your budget can strain your finances for years to come. Even if the bank offers you a larger mortgage, it doesn't mean you should take on that amount. Committing to a home that you can't afford can leave you with little room to save, invest, or even enjoy life without constant financial stress. An overextended mortgage also puts you at risk if your financial situation changes unexpectedly, like a job loss or medical emergency. Higher housing payments might force you to dip into savings or rely on credit cards, which can snowball into further debt. On top of that, larger mortgages often come with higher insurance, property taxes, and maintenance costs, all of which can add up quickly. It's essential to be realistic about how much house you can truly afford. You should also consider your lifestyle preferences and savings goals. Opting for a home that fits comfortably within your budget, even if it's smaller than what you desire, can provide greater financial flexibility and allow you to build wealth over time without the risk of financial strain. 4. Paying only the minimum on credit cards. Many people make the mistake of paying only the minimum amount due on their credit cards. While this can help avoid late fees, it's a dangerous habit in the long run. By only making the minimum payment, most of your payment goes toward interest, not the principal balance, meaning it will take years to pay off your debt. Meanwhile, interest continues to compound, making your debt grow even larger. This can trap you in a cycle of debt where it seems impossible to get ahead. Instead of freeing up money to invest or save for the future, your resources are tied up in paying off high-interest debt. Over time, you end up paying far more than the original cost of what you purchased, making your purchases significantly more expensive. The key to breaking free from credit card debt is to pay off your balance in full each month, or, at the very least, pay more than the minimum payment. Look for ways to reduce your spending and increase your income to eliminate your debt faster. Once your balances are paid off, you can shift that money towards saving or investing for your future, helping you achieve long-term financial success. 5. Co-signing loan for others. While co-signing a loan for a loved one may seem like an act of kindness, it can significantly impact your financial health. When you co-sign a loan, you are taking on full responsibility if the borrower fails to make payments. This could lead to unexpected debt that might affect your credit score and your ability to secure your own loans in the future. Co-signing a loan also puts your finances at risk if the borrower encounters financial difficulties and can't repay. Even if you trust the person completely, Life events like job loss or illness can make it difficult for them to meet their financial obligations, leaving you to pick up the slack. Worse yet, the loan payments could be a heavy burden on your own budget, potentially leading to financial strain or even default. If you're asked to co-sign a loan, it's important to think carefully before agreeing. Rather than co-signing, consider helping the person in other ways, such as offering financial advice or exploring alternatives like personal loans that don't put your finances at risk. 6. Skipping long-term care insurance. Long-term care insurance is often overlooked, but it is an essential part of a sound financial plan, especially as you age. The high cost of nursing homes, assisted living, and in-home care can deplete your savings quickly if you don't have proper coverage. According to the 2024 Genworth Cost of Care Survey, the median cost for nursing homes was more than $100,000 annually, and assisted living facilities weren't much cheaper. Without long-term care insurance, you risk spending your hard-earned savings to cover these unexpected costs. This can leave you with little to no money for other retirement needs, like travel or health care, which are also essential. Buying long-term care insurance in your 50s or 60s locks in more affordable premiums and ensures you're covered when the time comes. Taking the time to plan for long-term care expenses is crucial. Having insurance in place protects your finances and provides peace of mind, knowing you're prepared for the future. Don't let the high cost of long-term care drain your resources and derail your retirement dreams. 7. Having no living revocable trust. Without a living revocable trust, your estate could go through a lengthy and expensive probate process after you pass away. A living trust allows you to designate where your assets go without the need for court intervention. It provides a way for you to pass on your assets to your heirs while minimizing legal fees and taxes. This type of trust also gives you control over your assets if you become incapacitated. If you are unable to make decisions for yourself, the trust ensures that someone you trust can manage your financial affairs without going through court. It's an important tool for protecting both your assets and your loved ones. Creating a living revocable trust is not just for the wealthy. It's a wise move for anyone who wants to avoid the hassle and expense of probate. By taking care of this planning now, you're ensuring that your family's financial future is protected, and you're easing their burden in the event of your incapacity or passing. 8. Saying yes when you should say no. One of the biggest financial mistakes people make is agreeing to things they don't want to do, often out of fear of disappointing others. Whether it's lending money to a friend, co-signing a loan, or making an impulse purchase you regret, saying yes when you should say no can hurt your financial stability. Instead of agreeing out of guilt or pressure, take a moment to assess the impact on your finances. It's important to put your financial well-being first and avoid making decisions that don't align with your long-term goals. Saying no doesn't make you selfish. It shows you're serious about protecting your future. There you have it. 8 financial mistakes that could derail your future wealth. From taking on excessive student loan debt to co-signing loans for others, each of these mistakes can limit your ability to build long-term financial security. By recognizing these pitfalls and making smarter choices, you can set yourself on the path to financial freedom. If you found this video helpful, don't forget to like, share, and subscribe for more insightful content. Remember, making the right financial decisions today can create a wealthier tomorrow. Thanks for watching, and I'll see you in the next video.